Hi traders, I think we'll get started here. So welcome to this edition of Expert Market Analysis brought to you by Errante. This is a bi-weekly review and preview, as many of you know, so every other week of the market's key events and some of the trading opportunities. I think some of you will know we were out last week, but we start again obviously today and then in 2 weeks' time. While I just let you have a look at some of the disclaimers that you need to just browse through, we'll just run through some of the objectives of the webinar. We think markets are generally driven by themes which buyers and sellers relate to in order to enter and exit markets. So these stories or narratives can be long-term fundamentals or medium-term or short-term even stories and themes that drive the market in importance over time. So this week we'll look at the key driver, which is obviously certainly dollar strength, and also correspondingly to that euro weakness. We'll review as well some of the previous data from last week. So non-farm payroll, always important as a market driver, and we'll look at a couple of other data points which we think are worth highlighting. And then we'll preview this week's key events. Today's US CPI release, all eyes on this data point, driving potentially the Fed and their tightening path going forward. We'll look at euro-dollar in the context of this, and also the energy crisis really swamping, enveloping Europe and the euro, especially, as we know, close to parity. And then we'll also look at a couple of other things happening this week. One overnight was the RBNZ, so they hiked 50 basis points, and we'll look at that and the Kiwi dollar. And then also today's Bank of Canada rate decision, they're expected to hike as well. That comes 90 minutes pretty soon after the US CPI data, which is in less than 2 hours now. So expect some volatility for sure. And we'll just run through that rate decision potentially, and dollar CAD, and hopefully have some time to look at some of the crosses, Canadian dollar crosses really, which are probably more exciting than dollar CAD, which is obviously driven by external events around the dollar as well. Our goal really in these webinars is to break down all the market jargon and complexities that you read about. So if you do have any questions, please ask them along the way, and we'll hope to answer those as soon as possible, or at least after the webinar finishes. Right, it's just after 11 a.m. in London, so let's move on to the main topic of the market, which is definitely dollar strength and the corresponding sort of euro weakness for sure. We've focused previously on the dollar as a driver for markets generally, and the greenback has hit multi-decade highs now as the Fed has embarked on its policy tightening path. The above consensus payroll number, which we saw on Friday, that really helped cement chances of another 75 basis point rate hike from the Fed at its July meeting towards the end of the month. And this week especially, we've been watching for any news around the Russia-EU feud, around these gas flows, which has really been a signal over the last few sessions, over the last few weeks really, to sell the euro and buy dollars. Otherwise, really, it's all about global risk aversion and these recession fears. We've talked about these consistently over the last few weeks and months. And we've also got China growth concerns as well now. And they've resurfaced really this week overnight, even with this new rise in COVID cases in Shanghai, which is really fueling speculation of more restrictive measures being put in place in China, and so a re-rating of that economic outlook. And all things equal, then that gives further support to the dollar. Of course, regarding the greenback, we saw last week really this technical breakout to the upside. And here we've got this chart of the DXY, the monthly chart that is, And we can see really the dollar's been in a sort of decade-long bull run, really, from sort of 2011 lows here. And we've really pushed higher. Obviously, FX does, well, it doesn't move always in straight lines. And with every major dollar cycle, there are, of course, mini cycles. And certainly at present, we sort of track sideways, up and down, sort of late or sort of 2015 onwards, and then sort of 2021 really we've seen this uptrend, this strong uptrend in this sort of short-term cycle, if you like, and factors really have been dollar supportive, and that really can continue in the near term as we trade sort of around parity, as we mentioned, in euro dollar. We do note actually that investors are already overweight the dollar and dollar assets, and positioning is long, although it's not overextended. So something just to bear in mind really on the institutional side then. But really just to recap, the dollar in general, so it tends to do best in two distinct states of the world, if you like. So one, when recession fears pick up on the back of safe haven flows, and then two, when downside growth risks look worse outside the US. And then you get relative capital flows really amongst regions across countries. And both these states have really happened simultaneously, and that has given this strong dollar broad-based support. And if you put it another way, and really what we've been talking about over the last few weeks, especially regarding this inflation recession narrative, which has been behind a lot of the market moves recently. And it's kind of been a case actually of any news is good news for the dollar lately. So when markets worry about runaway inflation, the Fed tightening bets, they gain momentum, and we get higher treasury yields, propelling the dollar north. And then when traders panic about recession, of course, safe haven flows, as I've just mentioned, in a different way, they eclipse everything else. And we shouldn't forget that, obviously, with this equity market sentiment being quite subdued, but also going into Q2 earnings in the US, which kick off today, really, and this week with US bank earnings, which will be a key focus for stock markets, especially. But these Fed tightening bets, yes, they're continuing, and really these themes are probably going to continue through the summer months as we get less liquidity, and so volatility will be staying high. Tightening policy rates as well, and shrinking balance sheets of central banks. We mentioned QT before, so quantitative tightening with the Fed. That should also support larger realized moves in FX. And that's especially the case as we move through the business cycle and potentially towards the latter stages now of this current cycle. I just want to check out after looking at the monthly DXY, actually, just before we go back to that, I just want to show you actually the dollar performance recently. So the 1 week relative performance, and then 1 month. So that's the last 30 days. These are actually taken, these clips, on Friday. So that weekly performance from Monday to Friday last week, and then the monthly performance 30 days back from there. And really we could see, highlighting the greenback, obviously up across the board. Just the Aussie was beating the dollar, the main, obviously US dollar, over the last week. But obviously that's changed more recently. This week, the Aussie had been helped by decent trade data and possible Chinese stimulus, but obviously now, as I say, the Aussie's down. Actually, it's down over 1% this week against the dollar on the China news, and really remains vulnerable to any further equity weakness in the short term for sure. On the month, you can see not too much of change there. The Swiss franc actually is better performing due to its safe haven nature, and what we've called regime shift with the S&P hiking, that surprise hike by 50 basis points, and really the S&P, their central bank, being open to Swiss franc strength now, and really looking towards that to tame inflation in Switzerland, rather than the years that we've seen where the central bank has wanted the weakness in the Swiss franc. The flip side, as I say, has been to this dollar strength has been weakness in the euro, especially. It's been a laggard hit by these major concerns over natural gas supplies and the potential hit these might take to economic activity. Yesterday, we had pretty grim German business survey data in the form of the NZDUSD. And that highlighted the fragile nature really of growth sentiment in the Eurozone. But it's the continued rise in European natural gas prices which has really got the market's attention. I think 1 year ahead prices in Dutch natural gas, they spiked 30% in a few days last week. We had that strike by Norwegian gas workers actually, which was averted in the end, but would have come potentially at the same time as we're now getting this scheduled maintenance in the Nord Stream 1 pipeline. That kicked off actually the start of this week, goes on for 10 days. And really you've had this whole crisis really ratcheting up higher. You've had the French finance minister saying Europe must prepare for a full shutdown of Russia's gas flows. There's been speculation about gas rationing, and then the German government is now being dragged into state bailouts of utility companies. And I think indeed the German economy minister has talked about gas as potentially being a Lehman moment. So a lot of attention around this. We've been looking at headlines, as I say, this week around any news potentially about what Russia does. This really highlights obviously the region's dependency on Russian supplies. And there are these fears around Russia potentially taking this chance to halt or considerably trim at least their exports. And for markets, obviously, this is potentially going to hit European growth prospects. ECB policy tightening expectations have obviously now come in, and the euro certainly has been sold into. If we just go back then to the dollar chart. Firstly, I just want to show you on the weekly. Let me just pull that up for you. So here is the weekly that you can see. Sorry about that. Pause. Yeah, so obviously strong bullish uptrend this year. We've highlighted this during a lot of these webinars. Series of higher highs, higher lows. You can see. I think one analyst referred to this trend as like a coin trend, very strong indeed, not sort of parabolic, but dollar strength like this, not seen in a while, of course, upward bullish trend. We did have sort of that trend pause around the levels we've got on here. You can see 103.82, 102.99. Those were the March 2020 pandemic highs, and then also a high back from 2017, the start of 2017. Around here, we paused, pulled back, but then, of course, pretty constructive that the last few weeks of June, start of July, we consolidated above that 103.82 level, and then have pushed higher again through that previous June high at 105.78 there. Strong move higher through 106, 107 again, and then above 108 now. Where do we go? Obviously above here, the next resistance level is around, I think I've got 109.77. So if I pull back this the monthly chart here, yeah, we've got some sort of congestions around here, around the 108 level, but then potentially you go as high as the September 02 top, which was at 109.77. Yeah, certainly the bulls will be aiming for that. You can see I've just got an RSI here, overbought on the RSI, weekly as well, overbought, though we've pulled back from that sort of top out there, and then on the daily as well we're overbought. Doesn't mean we can't go higher for sure, but it's just a small warning sign that prices are extended here. Okay, we'll quickly now review some of last week's data, the non-farm payroll figure we thought was important for sure, always is important. And we had the FOMC minutes and some minutes from the ECB. Firstly, just briefly, those June FOMC minutes didn't add a great deal really, but they just highlighted Fed members' fears of entrenched inflation. They also recognised the possibility that even more restrictive stance could be appropriate in the Fed funds rate if elevated inflation pressures were to persist. And that means more increases, certainly of 50 basis points, potentially 75 basis points as well are suitable. And policy firming could slow, though, the pace of economic growth for a time. And that's obviously we talked around these recession fears. But clearly what markets want to hear now is what the Fed has in mind if economic data potentially does signal a deeper and more serious downturn without a similar easing in inflation. The ECB account minutes, similarly, they didn't reveal too much, but there is certainly a growing consensus for a larger 50 basis point increase at the July meeting potentially. Indeed, typically dovish Philip Lane, so the chief economist at the ECB, he said he didn't see a need for postponing a larger hike to September. On to the monthly US jobs report then, the non-farm payrolls, job creation remains strong, 372,000 headline print in June, and that was well above the consensus expectation of 265,000. There was a net downward revision to the previous 2 months of 74,000, but really a very solid report. And suggesting the US economy, certainly on the labour side, remains in good health. Total payrolls are now just above 500,000, below the pre-pandemic high, and it's leisure and tourism, the main areas of weakness still, with employments I think over 1 million below the Feb 2020 level. And that's all to do with a lack of candidates wanting to do those jobs that are remaining. And this chart here, I think interesting, it's the JOLTS survey, not often looked at, the JOLTS survey of vacancies. That got released a couple of days before the non-farm payroll actually, but it really shows the issue in the employment picture in the US. Certainly it showed more job openings, a lot more job openings than had been expected. And yes, the total number you can see there is down slightly from the highs, but it's still far, far above what we've seen before the post-pandemic reopening. I think ultimately there are nearly 2 job vacancies for every unemployed person in the US, and on the face of it, with that many employers looking to hire that many people, really it seems kind of slightly obtuse to brace for an imminent recession. But clearly companies are continuing to struggle to find workers with the right skills needed. Other details of the job data then, jobless rate stuck at 3.6%. That's just 1/10 above the multi-decade 50-year low. And wages are rising as expected. I think they were 0.3% month on month, 5.1% year on year. So really in summary, the report was a rare good spot, really, some good news amongst quite subdued recent activity numbers. And while markets and economists have been increasingly worried about that outlook, it appears companies remain upbeat, as we said, on their own progress, with the appetite to hire appearing undimmed, really, and it kind of gained a slight jolt to the recession narrative. This all, of course, makes it more likely the Fed will respond aggressively to the inflation threat we're seeing. And of course, that leads us nicely on to today's US CPI numbers, which we get, as I said, in less than a couple of hours' time. I'll just go on next to, this is the core US CPI number. Yes, this will be the most widely watched release probably on the risk calendar at the moment, really, ahead of the Fed meeting later this month. If we recap, May's unexpected jump to 8.6% in the headline print, that came about really when many thought inflation had peaked, and that helped also trigger the Fed's 75 basis point rate increase at its last meeting. And generally, economists think inflation is likely to remain elevated, with today's headline CPI accelerating to 1.1% month on month for 1% in May, and that will lift the annual rate from 8.6% to 8.8% is what is expected by most economists polled by Reuters, I think. Price pressures seem to be broad-based as well, so food, energy and shelter all contributing to the most to higher prices. So as I said, we've got the core CPI chart there. This strips out volatile items like food and energy, and that is expected at 0.6% month on month, taking the annual rate in the core slightly lower from 6% to 5.7%. And certainly the pace is slowing, with travel-related price categories such as airline fares and hotel lodging typically tending to decline on a seasonal basis during the second half of the year. And we've also had some business surveys like the S&P Global PMI that showed businesses raising their selling prices at the slowest pace in almost a year. And also, if you think we've had this rollover slightly in commodity prices, and that adds further weight potentially to this view. But obviously on the flip side, we've got probably a greater issue. We've highlighted this before, I think, and it's from rents and inflation in rents and also shelter costs, and that remains an upside risk. The May reading for both owners equivalent rent and rented primary resident, that showed the largest monthly increase in decades. And this chart here, you can see around shelter inflation hitting its highest level in 30 years. Generally, I think analysts expect this push higher to continue, and that certainly will give a floor to inflation near, say, 4.5–5%. And we must remember that's way above the Fed's goal, the Fed's target of 2%. So for markets, elevated inflation prints should really continue to weigh on sentiment, and appears very likely today's data will do nothing really to dent the market expectation of a 75 basis point hike again in July. It's these sticky price pressures really which should continue to weigh on consumer confidence as well, potentially. And just to highlight another data point this week, it's expected to show up in the University of Michigan survey on Friday, which is forecast to stay near its lows, I think around the 50 mark. It's really the rising cost of living then, and the falling stock market, or really instability in risk assets, which is likely to act as a tailwind. And we'll be watching the inflation expectations series in this data on Friday, as the spike seen last month was actually seen as by many as a trigger for the Fed to signal it was going to go 75 in June rather than the 50 it had laid the groundwork for. And I think even Chair Powell mentioned this survey as well. So something to look out for on Friday. And really another solid reading for these expectations should confirm, as we said, the second consecutive 75 basis point hike later this month. If we just drop to the CME Fed Watch tool we like to use and look at, and hopefully you're looking at this now going forward. Great website, really tracking Fed funds futures and what markets are pricing in for the Fed meetings. Next one, obviously 27th of July. You can see here then 75 basis point hike, nailed on, pretty much 90% chance of that. And then if we move to the next meeting, so that's not till the 21st of September. And there you can see, sorry, just going back briefly, you can see really 50 basis point hike is priced at 62% or so. So sort of 2 in 3 chance just below that, and then a 34% chance, sorry, of another 75 basis point hike in September. And if we just look to year end, interestingly, where we were sort of looking at the 3.5%, 4% mark for rates, really the chances are higher of a 3.5% year-end rate or lower now. So just something to track there as we go forward. It's worth looking now, we think, at euro dollar as well. This will certainly be affected by the US CPI numbers. And as we've mentioned, we've also been tracking sort of this gas news. Bank minutes, really just on the sort of central bank side, if we just recap there, comments from ECB policymakers in recent days really suggest a 50 basis point hike is in September after the 25 basis point increase later this month, probably. I know potentially some speakers have mentioned 50 basis points sooner rather than later, but at the moment priced for a 25 basis point hike later this month. The bar is actually next week, the ECB meeting, but the bar for the euro to make gains on the back of the ECB outlook is much higher now, and teeing up hikes really in line with market expectations doesn't look like it's going to rescue the euro anytime soon. Since not many economists, I don't think they expect meaningful support coming from ECB guidance, then euro probably needs an easing in these energy supply fears, which is unlikely ahead of this temporary shutdown of Nord Stream 1 for sure, its annual repairs over the next week or so. But obviously the ECB will have its eyes on this FX move, especially if it turns into a sort of sell Eurozone mentality. Although we do note actually that the trade-weighted euro, that's not faring as bad as euro dollar, and obviously the headlines around that major hitting parity. If we just look at euro dollar now actually, so that's the DXY. For euro dollar, we'll just check out the technicals here. Parity is obviously huge, psychological level as much as anything else, always big in FX. If we think of dollar Swiss, for example, recently when that hit 1, it then plunged in a matter of days, I think around 5%. Really for euro dollar then, it was the breakdown under 103.41 that reinforced that long-term momentum, that bearish momentum towards parity. We're trading under last week's low, just around 100.72, that last week's low is, so that sort of stands probably as near-term resistance. And then below 1, really, if we do break that decisively, there really are no other near-term obvious markers to watch. There is some congestion, I think, if we go back, highlighted that on the DXY chart, and you can see that on then the mirror image really in the euro dollar. So around August 02, September 02, we had some congestion around 98 or so. But otherwise you can see that break on the monthly for sure through that 103.41 level. And obviously much depends on the US CPI figures. Kind of feels like potentially a sort of data point, where we have a sell the news sort of fact, buy the rumor, sell the news sort of feel to it, especially with parity here. But the long term, so that what I'm trying to say is that we do get a bounce here above parity potentially, as we've sort of priced in pretty strong 8.81% print in the headline. Obviously, if we get something 9 point something, then for sure we'll break the parity level and then look towards the mid sort of 98 markers potentially being first support. But if we do get a slight easing in inflation, then potentially we will get at least a short-term snapback in euro dollar, pushing above, as I said, the near-term resistance around last week's low past 72, and then above that. So it'll really be interesting with this huge data point coming up, and we're trading around the parity level, which we often do see ahead of these key data points. So just policy-wise, I think we've looked at euro dollar there, but US CPI, of course. Policy-wise, There have been some decisions from the RBNZ, as I mentioned at the top of the webinar, and we've also got, of course, the Bank of Canada expected to hike rates. Firstly, then the RBNZ, that's the, oh, sorry, I'm just trying to pull up a chart here of the Kiwi dollar. Just bear with me 1 second, just go through here. Just get the Kiwi dollar chart for you. Always interesting. So yeah, RBNZ, markets expected another 50 basis point hike, and the bank delivered. Really, they pushed the OCR, the overnight cash rate, sorry, to 2.5% now. I think policymakers, they said it remains appropriate to continue tightening, and they're resolute in their commitment to ensure price inflation returns to the target range, which is 1 to 3%. The committee also agreed to maintain the approach of briskly lifting the OCR and remain comfortable with the projected path outlined in May. We also note that they did just sort of highlight near-term upside risks to consumer prices, but also medium-term downside risks to economic activity. Of course, more policy tightening could come at the cost of growth, and we note for sure consumer and business confidence is already near recent lows, and the housing market, housing prices in New Zealand are cooling. So at some point, we may be nearing a signal that the end of the tightening cycle is closer, but we've not reached that just yet. So for the Kiwi, was kind of not a great impact actually from the RBNZ. Really to be expected though, because the central bank really is secondary to how global sentiment and economic activity evolve. Generally, that's what pushes around the Kiwi dollar. Recession worries, of course, are currently dominating and putting pressure on risk sentiment and commodity prices. And that is certainly has been negative for the Kiwi over the last few weeks. We can see that downtrend really from the April highs above 70 there. Strong downtrend. We did move back at the start of June to a high of 65.75, but from then really the downtrend has continued. Really, these relief rallies that we're seeing a sort of classic bear channel, so series of lower highs and lower lows. And really these, as I've said, these relief rallies are quite likely to remain shallow in the current environment, and certainly until nerves around global growth calm down. Last week's low is probably the key support. That's around 60, just checking there, sorry, 60.97. So that will be key support for sure, unless that gets broken, of course, around the CPI numbers. Resistance above is probably last week's high at 62.52. There's also a Fibonacci level around 62.37 to look out for. But the downside for sure, if this near-term or sort of medium-term really bear trend, if that continues, breaks last week's low, then we're really looking at big figures really. So 61.61 and then 60 as levels for bears to target. Concerning the Bank of Canada, then the other meeting. Let me just pull up the charts here. Sorry, bear with me 1 second. Which is here. So yes, dollar CAD, sorry about that. Yeah, we get the latest policy statement in a couple of hours time. At the same time, we get updated forecasts and assessments in the monetary policy report. So Bank of Canada really set to follow the Fed, raise the policy rate by 75 basis points. That'll take the rate to 2.25%, so 2.25%. Markets actually are pricing in, I think consensus, sorry, is pretty nailed on for a 75 basis point hike, but markets actually are pricing in between 75 and 100 basis points. So around 87 basis points, I think, of tightening. So another half of another quarter point, if you like. Quite interesting there. So it was really a significant upside surprise to CPI in May. That was a key factor behind the expectations for a larger rate move compared with the 50 basis point hike in June that we saw. In May, I think inflation rose to 7.7% year on year. That was the highest since the early 80s. And price pressures also continue to broaden amid an economy really that is in excess demand. So trade is really expecting the bank and us for sure to take a larger step in an effort to cool off domestic demand with an objective of eventually bringing inflation back down to its 2% target. So a long way from there still. And price action then during or around the meeting will probably be governed by, well, for sure, if they go 100, then that will be a surprise. And then also governed by guidance and the tone of the press conference and the updated economic forecasts. Policymakers, really, Governor Macklem expected to repeat previous guidance, which means taking the overnight rate to the upper end of the 2 to 3% neutral range. So if we get the 75 expected, that takes it, as I said, to 2.25, and then we have a hike of an equal size, another 75 basis point priced in for September. So the stakes are high, as I say, especially because of the range of outcomes. I think some analysts do have just a 50 basis point hike and then obviously a 75 and also the 100 basis point hike. So we should expect some volatility certainly around this number, this meeting, this decision. You kind of think the bank has always previously guided in the last few months around being gradual and measured. So a 100 basis point hike, really, would that be seen as a kind of panic move potentially? So just looking at dollar CAD finally, similar to the Kiwi, really the CAD and other pro-cyclical currencies, key drivers are obviously external. It's around the risk mood, equity market sentiment and commodities. And for sure with the Canadian dollar, we've had this recent oil sell-off as well. So downside risks really near term remain significant. For dollar CAD, you've had solid gains. If we just look at the chart here, we had solid gains at the end of last week, really, and that kind of improved the technical picture, which was certainly increasingly bearish. So that means dollar CAD moving higher, especially with that tip through 130 last week. We've then seen some buying pressure again around the 129, above that 129 level, pushing us again towards 130. So where do we go from here? Obviously small range today, big resistance zone, as we can see, and as we've highlighted there, from previous highs in May, June, and then July at 130, 76, 78, 83. So big resistance zone there. Which again, if we have a strong CPI number, potentially we push higher through sort of 130.76 area. Support probably last week's level there, 129.35, and then around the 129 figure here. For the CAD in general, we have to remember, of course, this is obviously against the US dollar, but the domestic backdrop remains fairly positive. Of course, you know, you've got aggressive Bank of Canada tightening for the rest of the year, and you've got a really quite a strong economy, tight labour market, and obviously commodities have taken a pullback, but are still means the Canadian economy is relatively insulated compared to, say, Europe. And as I mentioned again, then Canadian crosses really are probably quite interesting at this point in time. The EUROCAD, for example, that's nearing its spike low from April 2015. That's just above the 130 level. So just something to look out for, as well as dollar CAD. Just look at some of the dollar crosses, the Canadian dollar crosses, which are at key levels, and really looking out for then the Bank of Canada decision. Okay, I think we've covered quite a lot this week. US CPI on tap very soon. Good luck with your trading, of course, and we shall hopefully speak to you in a couple of weeks' time.